You're diversifying wrong, and this one secret will be able to boost your performance in your investing in your assets over the long period of time. So what do I mean by this? Let's get into some context with the story. So my friend Gavin was texting me. He knows I like investing. He was like, Josh, what's your favorite stock pick for the next 5 years? I'm like, Amazon easily. I hold it, the majority of my portfolio in Amazon. He's like, Josh, what if you love this company so much and have so much conviction, why don't you put all of your money into this one single stock? Well, I'm like, Gavin, any average investor knows you have to diversify your assets. But then it got me thinking. We're talking about ETFs, growth ETFs, baseline ETFs like VU and SPLG, and even dividend ETFs. He's like, Josh, don't you want to put your money in what grows the most over time? And he's like, yes, of course. And that's where we hit the mark. In this video, we're going to get into the question, should you throw all your money into a growth ETF? So I know that sounds like a very crazy statement, but we'll get into the reasons why using statistics backed by facts, and I'll run the calculations live on here for you. So for the average investor or the average safe investor that wants to kick back, relax, and not worry about diversifying or doing anything, just putting their money in over time, one of the most popular funds are VT, which is the worldwide index, VTI, which is the whole of the United States stock market, including small caps, and VU, or SPY, and just the top 500 companies. So what is wrong with these? So let's start off the top. There's fundamentally nothing wrong. It's the key definition of diversification, spreading your assets out into this international stocks and emerging markets, even putting some money into bonds too for a safe investment. Of course, there's nothing wrong with a safe investment, but a safe investment doesn't mean it's going to grow over time. Over the long run, international stocks and emerging markets have insanely underperformed United States stock. So what's the solution to that? We want to put all our money into United States companies using SPLG or VU. Well, Josh, don't you want your money to be stable? United States companies are more volatile than international companies, or smaller cap companies let you get more diversification. Well, this volatility is not a bad thing. Have you ever heard the term buy the dip? Of course, using statistics, we can see that lump sum investing, which is putting all your money in at once, wins 75% of the time, but that's only 75%. So we can put a majority of our money in at the same time and hold more, since these funds, the United States, tend to be more volatile and prone to crashing or pullbacks. So back to our question: can we put all our money into this growth fund? We can pick my two favorites. Either one, the Charles Schwab Growth ETF, SCHG, or we can go on the NASDAQ 100 top technology stocks, and being the QQQ or QQQM, the expense ratio of 0.15 or 0.2, which isn't terrible. So let's look in the long run. These companies outperform in the long run over everything else. So what is wrong with putting your money in here? We have the fundamental risk of technology being its highest sector at around 50% of both of these funds. Under 50 for SCHG and above 50 for the NASDAQ 100 or QQQM. So why do we have this risk in here? Well, because technology has ran up so much with extremely high valuation. So anybody that doesn't want to hold strictly technology will hold something else. That's why we get the VT, the worldwide in there. That's why we get the small caps in there. But why is that a bad thing? Why do we want this high valuation? Well, because even with the high valuation, that's because the high growth. These companies that are valued highly and are more expensive to buy is because they have more growth potential. We can't just go purely off the numbers. In the long run, QQQ, the NASDAQ, the top 100 technology companies in the United States have outperformed SCHG, my favorite growth ETF of all time. But why is SCHG better for this diversification asset? It's because it has a baseline, it has a tracker. For a stock or company to get inside SCHG, it has to hit specific growth marks. So what is the screening process for SCHG and what makes it better than the NASDAQ 100 or QQQM? Well, with this growth classification, each company is either classified as growth or value based on its fundamental characteristics. This classification is determined using a factor of 6 different screening processes, including projected earnings growth, historical earnings growth, trailing revenue growth, and projected revenue growth. So what does that mean for us? It means that all of these companies inside of SCHG are taken from something similar like the NASDAQ 100 and screened for these good qualities, which means it kicks out any new companies that may have gotten in that don't have 5 years of great growth or are projected to grow 5 years in the future, which means we take out the fundamental risk of taking in these overvalued companies. Well, still we cannot ignore the historical fact that QQQM has outperformed. Another reason why I like SCHG is because it's a lower expense ratio of 0.04, which is insane compared to QQQM's 0.15, which is going to save you thousands of dollars in the long run. So we can't ignore these historical values still of QQQ outperforming. So what do we want? Of course, we need some sort of diversification outside technology sectors. So that's why I want a 40% allocation into the S&P 500, because we want the big, large cap companies. We're avoiding the small cap and we're avoiding the international stocks and bonds for the growth. So we have 40%. Next, our core component, we have 50% SCHG for its low expense ratio. Of 0.04 to get that maximum growth with the screening. And lastly, 10% we have in here QQQM or the NASDAQ 100 top technology stocks, because you can't ignore the historical facts of QQQ outperforming, even though I do think SCHG is going to be better into the future because of these high valuations. We want a little piece of that. We have a little piece of that in case it does outperform. But if it's higher than we want expense ratio, we're going to have it only at 10% of our portfolio. So you may be wondering, now we have this ultimate portfolio here that positioned for growth. We are worried about the volatility and the crashes. They tend to go down more than that baseline in stock market crashes and pullbacks. Well, it's not a bad thing. Like I said, let's go back to our basics and statistics. Lump sum wins 75% of the time. 75%. That means we should put in 75% or more of our money in all at once. And that other 25% or less than 25%, 10%, 5% we have left, we're going to keep it on the side in either a high yield savings account or inside our investing account if it has a high yield of around 3 to 4%. So build on top of that. And if there's a pullback or a dip, we buy hard into it. Think about it. It's one of your favorite ETFs is on sale. So instead of international stocks or the whole S&P as a total going down 10%, this could go down 20%. Well, that's a perfect buying opportunity for us, because once you buy in the lower, it's going to be low. We already know in the long run, it's going to shoot back way past up the S&P 500. So that's why we have this money on the side for the buy that dip opportunity in a perfectly entwined combination of lump sum, DCA, and buy the dip. So to answer your question, Gavin, no, we can't put all our money into Amazon, but what we can do is overweight our portfolio into growth if we have a long time to live. But if we are on the older side here, of course, you do want to be more conservative. So over my lifetime, since I'm a young person, we will slowly start putting our money into these safer assets. But for growth in the time, we are gonna go as heavily growth as possible with as little risk as possible with this diversification.